Welcome, everyone. My name is Dimash, and you're listening to Big Sky Capital podcast, where we're speaking to big sky thinkers in the world of startups and venture capital. Our guest for today is Radek. He's the CEO and co-founder of investment platform named Kyle. Hi, Radek. How are you?
I'm very well. Thanks for having me.
First of all, tell us a bit about yourself, your background. I know you're from Czech Republic, and how you ended up in Singapore building startup.
A nice question. Yes, I am from Czech Republic, and I've been traveling quite a lot since 2006. Actually, I haven't been living in the Czech Republic, although it's a great country to be in. So I am by background IT project manager. I always worked on the edge of the IT of the business. I worked in the telecom companies. I work in banks. I work with consulting companies, working with banks and telecom companies for more than 15 years, I'm afraid to say, in different countries. And what brought me to Singapore was my last consulting business. My clients have invited me to come to Asia to help them. And while being here, I was thinking, wow, this environment here in Southeast Asia is much more dynamic than what I experienced in London, where I've been before. So I was thinking, why not to actually stay and build a business around here? So instead of in London, I started hiring people in Singapore. And in about like 2 years' time, we built a $1 million recurring revenue consulting business focusing on using data analytics in large operational processes, mostly for banks and payment companies. These were our clients. And then
Mhm.
after like doing it about 3 years, then I was thinking, okay, it's nice to have a like consulting business, but it would be even nicer to have a product business, right? Because product business is way more scalable than doing consulting. Consulting is a function of how many people you have, how many people you're gonna sell, right?
Mhm.
So you can grow very nicely. They have very nice margins, but it's not something which is ultimately scalable. Hence we set up a Kilde as that product business, and we wanted to do something which is not very far from my co-founder's experience, which is credit analytics, using data to make decisions, right, and using technology to make processes scalable.
Yeah, then tell us a bit more about your product, about the startup, and what problems it aims to solve.
Sure. So we are an investment platform, and I better explain it from the investor perspective. So we work with fund managers, wealth managers, financial advisors, and with also high net worth individuals themselves to give them access to private credit deals, which are backed by certain cash generating assets. And sorry as I'm being a little bit technical in here. And we've been quite successful doing it for the past 2 years. So we have more than 10 million of assets under management. We have given back our investors 11.6% return in 2022, which is why everybody in the similar asset classes were minus 12% and more, the benchmark. So basically twice as much return. The year before, we gave them 10.48%. So I think we've been quite successful in delivering the kind of returns that they expected. But what is like unique and important about this product, as opposed just like buying public fixed income instruments, like buying stocks, right, with your interactive brokers account or this, because this private credit instruments are so-called not correlated with whatever is going in the public market. It's not correlated to the financial markets, might be loosely correlated to the economy itself. It's another topic. So it gives it interesting property that during the market turmoil, as we have seen the last year, and as we a little bit see, so in the beginning of this year, you can count on a stable income, and this is very much welcome for a specific kind of funds. It's called private credit funds. It's also very much welcome for high net worth individuals, which usually like hold most of their wealth in some sort of debt. Typically is a public market debt, but nowadays increasingly the portion of this is held in a private debt, and that's where we play. So that's one part of the business, the I would say investor allocation like business, and the other part of the business that then we look for large profitable companies in the Central Asia and Southeast Asia, which have a cash generating asset, which we take a collateral and give them a loan. And those companies happen to be, again, based on my previous experience, consumer finance firm, buy now pay later firm, salary loans firms, SME lending firms. So this is also the way how we contribute to growing the lending ecosystem in the Southeast Asia and helping people and businesses to reach out to the credit, which is not often available from the banks.
Mm-hmm. And what's the biggest challenge you're facing as a CEO? Asking for our portfolio companies, founders, and the other founders who listen to this podcast.
So I think the challenge varies on where are you in the stage of the business. So we face very different challenges 2 years ago, different challenges a year ago, and different challenges we have now, which is a part of your growth. So currently, when we are post-seed stage, right, and pre-Series A stage, we need to show a very good dynamics of the sales, right, and the development of the product. So for me, the biggest challenge to shape the product to the right audience, to the right customer segment in a way that they will be buying it in a great amount and great volumes, right? That's what's the biggest challenge. The second challenge, which is like leading it to the first, is to have a great team and to have a very motivated team. Because if you're in a startup, your people needs to be 10 times more productive than people in the corporate world. It's just in a small, like 10 plus people startup as we are, right? Everybody's performance is visible and it's impactful, right, for the whole business. And in order to make this enormous task to lift the business from 0 to 1 and to from 1 to 1,000, you need really great people. And that's that I would say it's a big challenge. It's good that we are in Singapore, where it attracts a lot of talent. Around here is a great universities, right? So generally the level is very high. Last but not least, which is like a universal for startup at any stage, is reacting to the changes and challenging outside. So just life throws you lemon like all the time. And I would compare it like perhaps the startup is like a small propeller plane, right? Like in a wind, right? And sometimes the hurricane out there, so the plane is like it's hard to keep on track. Versus like a big corporation is like a jumbo, where it might be shaking a bit, right? But actually, like the plane stays kind of stable. So reacting like a well on the challenges which outside environment throws at you, it's a crucial skill of the CEO and skill of the team to be adaptable to these challenges.
All right. We, as the Big Sky Capital, participated in your fundraising round. And how much you managed to raise, and how much time it took in today's environment
Hmm.
close the round?
So far, yeah, thanks for the question. So far, we have raised 2/3 of the round, so it's a 1 million we have raised. Previous round, in total, we raised 800,000 US dollars. So we are $1.8 in the past 3 years funding, and it takes a while. It depends like when you start measuring it, but usually it takes between 6 to 10 months to actually raise around from the initial conversations, right? Then you say, okay, we have a general understanding, but you still need to do all the paperwork, right?
Yeah.
Till the end. So it takes a while. What really helps in the process is to have a lead investor, right? If you have a lead investor, which is somehow somebody who is reputable in the industry, right, and take an opinion on the deal and set the valuation, like for your confirm your valuation as it was in our case, then it becomes way easier to actually collect the follow-on investments.
And how many investors you outreach in total during the fundraising?
Not so many, surprisingly. So we didn't go for the strategy. It would be like a messaging everybody on LinkedIn or doing email blasts and kind of things. Because we are a specialist company in the financial industry, we are best understood by other people in the financial industry. So apart from VCs, we have gone after financial like investment firms or even individuals who might be managing directors in investment banks and firms, which we understand the product, right? Because they understand this B2B nature of the product, they understand the challenges though those customers are facing, and they see value of the product. Hence, the conversation with them were much easier, and they also understood one very important property in the startup in the capital markets, right? The scalability is immense. Like in a small teams, you can be in tens of millions as we are. You can be in hundred millions. You can be in billions, and it is still reasonable size of the team, right? Especially if you are technology driven. If you have a lot of technology behind you, how you automate your processes, your investment processes. So so there've been a lot of value. So how many like did we reach out? Like I'm not sure. Probably it's going to be less than 50, I think. Yeah.
And what's the common reasons where like VCs turned you down?
Ha ha ha. I think honestly, after 3 years like being in a startup, I started eventually to understand how actually VC like work. And after conversation with the VCs, I had,
Was it
which they
mainly
open
because
up
of the business or because of the macro environment?
because of the VCs themselves. Because the VC has you need to, and that's something I would advise to the startup fund. You need to understand the VCs because they are in a way your customer, right? If you want to raise money from them, so you need to understand what kind of product they are buying, what kind of product they are selling, right? So what I understood that especially the pre-seed and the seed like funds, right? They are often going to be exiting during later series. Right? They might not be waiting until IPO or a sale of the company. It might be exiting in a B, C round, right? D round, right? So on. So for them, it's important to have like a product which is maybe 3, 4, 5 years down the road can be sold to the bigger VCs, right? Or it can be sold to a corporate acquirer, somebody like that, right? And usually, like for them, it's much easier to invest into trends. So every year or every few years, we have a certain trends,
Yeah.
right? And certain businesses which fit into these trends. And they are basically looking like for companies. Are you business like doing this and this, right? In this, are you yeah? And they might have a few companies. So you don't need to be as a startup founder very original if you want to raise from VCs. Actually, if you are very original, it might be to your detriment because there's a template, right, to the decision making. And I think the reason why we have been turned down is perfectly normal to be turned down like most of the cases. It's like dating. You're gonna be turned down like most
Yeah.
most of the cases, but you don't need like everybody, right? You need one. Right? You need one lead VC, right? You don't need many lead VCs. So it's okay to be turned down. It's the reason that if your product is like a more original and sort of like a more solving a certain issue which is like a less visible and less obvious, right? Then it's a less attractive to the VCs generally, right? And I think this is a little bit our case where we are very attractive to other investment firm, and they are very cash rich, right? Those firms, because they are usually investment firms are very profitable, usually if done right, right? And we have closed like funding with some of the investment firms like within weeks because they immediately got a product. Wow, amazing! Can I see this? Can I see that? Wow, where can I sign? I want to invest, right? Versus sometimes with the VCs, you need to actually educate them about the market, and they might will not always be the expert, right? In your market, you
Yeah.
as a startup founder, you are the expert in the market. So also Also, sorry, I'm giving an unsolicited advice. Be careful taking advice from VCs because you know much more about your market than the VCs. Yeah. Often it's useful, right? But I think VC advice, just to be fair, to be balanced in both sides, VC advice is very useful on more like a generic things, corporate governance, right? How to set up a team, how to motivate your team, right? But be more careful about VC advice about very specific things you need to understand very, very well as a startup founder about your market, about your customers, right? Who is your customer, how the product like should be. There you should be the one, like knowing, right? And understanding and discovering.
Yeah, that's a great answer. And for how many months are you secured in terms of runway? And what runway must the startups have these days, in your opinion?
Yeah, so generally it's said that you should be at least like a 24 months runways these days because sort of the fundraising environment is a bit tougher than it used to be. I think it's a bit like kinder to the seed stage companies around, so early companies, and it's a little bit less kind to the later stage companies, right, which need to scale. And they might be like 2 to 3 years from IPO, and now they need to raise the Series C, D, right? There is a quite actually tough environment for them right now. So generally it's 24 months, but I think there's no like a right like a fit, like a right number, right and wrong number. Because on the one hand, you can be very economical, very frugal, which we think we have been like all the time. But it's very hard to grow, right? If you are very frugal, you will not spend on marketing, you will not spend on these things, and you might be forfeiting certain opportunities, right? On the other hand, you might be very like giving out, like investing, flooding the market with the money, like paying your customers to use you, right? This is the other extreme to it, saying you're gonna grow, but that growth might not be profitable growth, right? So I think the truth is somewhere in the middle, and it's a specific for every startup, and the runway really depends on these decisions, right? So you want to take a bit more risk, like accept, okay, I'm gonna have a shorter runway, but again, I'm gonna have a shot to double, triple my business, right?
Yeah,
Which
that's
you ultimately become very valuable, right? If you're able to do this.
Mhm.
And you should be doubling, tripling your business every year, right? If as an early stage startup, or you say I'm gonna be in a survival mode, and I'm gonna be very frugal, and I'm gonna just keep business and maybe growing like this. That's probably fine as well, but that's not why the VCs invested in you, right?
Yeah,
They wanted to have the growth like this, not growth. This sounds like a
actually,
normal business, right?
yeah, and have somebody help you with the fundraisings, mainly lead investors, or maybe some intermediaries in the market, some agencies.
No, so there were agencies who were approaching us like all the time to help with the fundraising, because again, because I think we are a little bit special case where we need like a deeper education of our both our customers and our investors. That's never been very productive. A relationship with these like a fundraising counterparties, intermediaries. The lead investor, like the fact that you have a lead investor helps, but it's not necessary that lead investor would bring other investors. So in our case, all the investors we brought ourselves. So yeah, so really we did ourselves.
Mhm.
So that they have been kind advisors like to us, those which are advising us, which are current investors, right, are sitting on the advisory board. Also the external like friends were looking into the fundraising materials, helping us to shape it, right, helping us to have like a more conversations, right, with potential investors. And even if the conversation didn't end up in investing, we heard the questions, right, they were asking, and we kept improving the fundraising materials, the due diligence data room in the shape that then we were quite good. So it's a good learning process.
Mhm. Yeah, great, great. You already touched that the problem is in VCs itself, and what's the main traits of the good VC in your opinion, from your side?
So I think that that's a tricky question because like
How
from my
VCs
side, right? If you ask from my
behave.
side, right, who's the trade of the good VC? But it doesn't mean that it's like a good VC general, right? So in my trade, somebody who will be willing to spend time, right, to understand uniqueness of your situation, your business, support you, give you open up the Rolodex, right, connections to
Yeah.
you, being vocal, right, about I have invested into the business, I really have a belief, right? So that's really good. So have a good name, VC, like Big Sky Capital, for instance, to have an in a cup book is really good. It gives a good signals. Having again somebody looking from outside on the business and especially advising, as I mentioned, to those like areas like cup book management, ESOP, right? Corporate governance. That's great. That's great because it lets me as a founder focus more on the core business, right? And that's very helpful. If it is a trade over like a generally successful VC, I'm not sure. Uh, Again, it's a very tough market for the VC. I sympathize like with them a lot because only about quarter of the VCs actually are able to raise the next fund. So the failure rate actually of the VC is very similar to the failure rate of the startups, almost the same, right? So so it's a very tough job, and they really need to have the timing right, right? Get into the right deals, and we are now in a different part of the economic cycle. And the challenge to a lot of like a young VCs is that they haven't seen the previous cycle, so they invested only in one cycle, and they might not appreciate, right, the dynamics of how the cycles kind of work, right? When you are down, what you should be doing, then how to prepare yourself for the upcycle again. So yes, so you see with the VCs, we need to support each other. The startup needs to support the VCs, and VCs should support their startups.
Yeah, we see a lot of startups that even the good startups that cannot manage to close the round or close the whole round. Do you have some tips and hints how to work with VCs, how to close the round?
Build a great business, right?
Yeah.
That's the ultimate tip. When you have a great business, right, everybody will want to invest to you. So kind of like
Oh,
it's like almost 0-1 situation of often with the startup. So either like everybody wants to invest into you or nobody wants to invest to you, right?
yeah.
So it's kind of like that, and it really depends if you have a good business, if you have a good traction, if you have a good product, right? If you have a good team, then people will naturally want to invest to you, right? Versus if it's not the case, then might be tough, like to convince investors. So I think in any part of the cycle, right? We are in the down cycle right now as an economy generally, right? As an investment environment, like the good startups will get funded, but they need to be like out there. They need to be doing very well, and they also need to be very visible, right? That's maybe the advice I could give. That's some of the like startup founders have a good business, but they are not on the top of the mind of the VCs, so they need to make themselves like visible through social media, right? Through giving talks, right? Reaching out like to VCs. So they should have this little bit PR themselves, and I think it's important right now. And I think also, sorry for saying a cliche, that a lot of like a good companies has been forged actually in the downside, in the recession, right? In the time of the economic crisis, and it's the reason is twofold. The reason is one, only really like a good companies. It's kind of the crisis situation. It weeds out opportunistic founders, right? Who are not there in the long haul, right? For the business, who just give up, right? Basically, okay, it's a difficult environment. Okay, so I
Yeah.
tried, sorry, right? They just give up. So there's a that maybe it's easier for you, like VCs, okay, and who stayed, right? Who is like still going on
The
there? So
strongest
that
survive.
yeah, the strongest survive, who have really the product, right, which somebody wants. And the second thing here is that it's also a bit more like opportunistic because the valuations are like a more normal, right? The situation is bit more normal, and during the crisis, there's a lot of changes. So the industry sometimes get reshaped, right? Now we see like in the capital market is a big like a shift, right? So people are shifting back to the fixed income, right? They are going out from the high risk equities, from a little bit. They might be pulling out from emerging markets, maybe. If depends. So these period of changes, they are actually quite very fruitful to be a nimble startup, right? Who can like navigate this and make a good use of it. So I think this is the second like a big reason why the good startups are fortunate in times of crises, because crisis means change, and crisis means opportunity.
Yeah. All right. Thanks you a lot, Radek. I hope you enjoyed our conversation, and
Excellent.
I hope our listeners enjoyed our conversation. Thanks, everyone. You listened to Big Sky Capital podcast, and till the next episode. Thanks. Thank you, Radek.
It was a pleasure, Dimash. Thank you very much.
Thank you.